My growth dividend portfolio has outperformed the S&P 500 so far this year, and with the S&P up almost 20% year to date, I've been doing pretty well. That's why today I've decided I will be revealing my $28,000 stock portfolio. As I mentioned, my portfolio is based on a growth dividend strategy, so a majority of my stocks I will be revealing are growth stocks that offer at least some dividend yield. My goal with this portfolio is like many others, generate enough cash so that eventually my dividends can pay for my retirement. One thing I will note is that my list does not include ETFs as I'm invested in none, so ETFs such as VU or SCHD will not be on this list. My portfolio consists of just 9 positions and I will reveal them each starting with the lowest percentage of my portfolio and going up from there. Before we start, make sure to subscribe to follow this portfolio's journey because I will be posting updates to this portfolio pretty often and other stock related videos. Now, my ninth biggest position is the NASDAQ company, ticker NDAQ. And when I say NASDAQ company, I do not mean the NASDAQ composite, I actually mean I'm invested in the company itself. Now, this is my smallest position, as you can see on screen, I only have 5 shares of this company at around $50, which means I only have around $250 in this company, and even though it's my smallest position, it's still one that I think is worth talking about. Now, it does have a dividend yield at around 1.8%, but that isn't a good enough reason to invest in it, so why am I invested in it? Growth potential. NASDAQ Inc. is one of the world's leading stock exchanges, providing a platform for companies to list and trade their shares. As the global economy theoretically expands and more companies seek to go public or raise capital, NASDAQ will benefit from increased trading activity and these listing fees. Its continued growth in transaction volumes and listings can potentially drive the company's revenue and profitability higher over time. In addition, this company has a much lower PE ratio to similar companies such as SPGI. In my opinion, and it's at a pretty good price right now at around the $50 range, and it's a pioneer in financial technology and it's pretty well established. So although it's my smallest position, it's one I can see myself adding to a bit in the future. Now, my 8th biggest position is Ares Capital, ticker ARCC, which I have about 118 shares of, and it makes up about 8.4% of my portfolio. If you know anything about Ares Capital, you know exactly what I'm going to say about why I'm invested in this company. It's because this company has a super high yield and a strong dividend history. Ares Capital is a BDC, or a business development company that primarily invests in middle market companies. It has a history of paying consistent dividends to its shareholders, so for investors seeking a steady stream of income, ARC's reliable dividend payments are super appealing. Not only this, but ARC's dividend yield is stupid high. It's about 10% and it pays quarterly. And although the stock price can take hits when the market does poorly, it has continually managed to recover over time and eventually continue to pay this outrageously large dividend. It's also an inflation hedge. Inflation's a word that's been thrown around a lot recently, especially in the US as inflation has hit new highs, but inflation can erode the purchasing power of fixed income investments. However, equities, including dividend-paying stocks like ARC, can act as a hedge against this inflation. And as the company's earnings and dividends grow over time, they may outpace inflation rates, helping investors maintain their purchasing power. Not only this, ARK is doing really well right now due to high rates, which means they can make more money off their loans to other companies. Now, my 7th biggest position is United Health Group, ticker UNH, which I have 5 shares of, and it makes up around 9.2% of my portfolio. Now, there are a ton of different reasons I could tell you why to buy this stock, but one that I'm sure we all know is that healthcare in the US is really expensive. In 2021, $4.3 trillion were spent on healthcare in the US, and when compared to other countries, that's an absolute ton. In addition, United Health Group holds a dominant position in the US health insurance market, and its strong market share and brand recognition give it a competitive advantage over its peers. Even though United Health Group is mainly known for its growth opportunities, it also offers a pretty good dividend at around 2%. Investors seeking both capital appreciation and a steady stream of income should find UNH's dividend pretty appealing. The company also has a long history of increasing its dividend over time. The healthcare sector, including health insurance companies like United Health Group, is relatively resilient and less cyclical when compared to other industries. People require healthcare services regardless of economic conditions, which provides stable revenue stream for the company. This stability should be attractive to investors looking for a mix of growth and safety in their portfolios. Lastly, the global age is expected to increase, and as age increases, so do healthcare costs, and UNH is in a prime position to benefit off of this. My 6th biggest position is Starbucks, ticker SBUX, which is a company you will most definitely already be familiar with. I have 28 shares of this company, which means it makes up around 10.2% of my portfolio. The reason I'm invested in this company, even though it has a good dividend, is mainly because of its strong growth potential. The company continues to expand its store network in both existing and, more importantly, new markets, which provides significant growth opportunities. As consumer demand for premium coffee and convenient food offerings persists, Starbucks is well positioned to capture a large share of the market and drive revenue growth. Like I said about new markets, Starbucks already has a presence in numerous countries around the world. However, they're expanding internationally in operations that are in emerging markets with growing middle class populations. This poises Starbucks to be in a really good position to make even more money outside of the US. Not only this, but Starbucks has really shareholder friendly policies. Starbucks has shown a dedication to creating shareholder value through both share repurchases and dividend increases. Share buyback programs enhances the value of outstanding shares and indicates that Starbucks has confidence in the company's future performance. My fifth biggest position is American Express, ticker AXP, which I have 20 shares at around $165, meaning it takes up around 12% of my portfolio. This is my largest position in a company that is related to finances, and the reason I invested in this one is because of brand strength and market position. American Express has built a strong brand image associated with premium services and customer loyalty. Its charge cards and credit cards are widely accepted globally, giving the company a competitive advantage and positioning it for continued growth. In addition, the fees they charge on purchases are pretty high and allows them to get good profitability. American Express also has diverse revenue streams. In addition to its credit card services, American Express generates revenue from other financial services, including merchant processing, travel services, and loyalty programs. This diversification reduces the company's reliance on a single revenue source and enhances its ability to adapt to changing market conditions, which is something it's been really good at. And similar to Starbucks, I mentioned earlier, it's a multinational company that also employs shareholder-friendly practices such as share buybacks. As the economy continues to expand across the world and consumer spending increases, American Express stands to benefit from higher transaction volumes, leading to potential revenue and earnings growth. My fourth biggest position is the Union Pacific Company, ticker UNP, which I have 15 shares currently at around $230, which is good for me since I purchased at low 190s. Overall, it makes up around 12.5% of my portfolio, which is slightly larger than Amex. A big reason I invested in Union Pacific is because it is an essential industry. Union Pacific operates in the railroad industry, which is a vital component of the transportation and logistics sector. And Union Pacific, being one of the largest and most efficient railroads in the US, is well positioned to benefit from the ongoing economic growth and trade activities. Not only this, but Union Pacific has a geographic advantage. Union Pacific's extensive rail network spans the continental United States, connecting major industrial centers, ports, and key markets. In addition, there's a large barrier to entry with this type of company. It isn't easy for a company to just come along and build railroads like UNP already has in the United States, and it's obvious because this company has existed since 1862 and has paid a dividend for over 120 years. The last reason is cost efficiency. Compared to other modes of transportation, such as trucking, rail transportation is often more cost-effective for moving large volume of goods over long distances. Union Pacific's efficiency in operations and cost management can lead to higher profitability and potential earnings growth. My third biggest position is the company Apple, which I have 20 shares of, and it makes up around 13% of my portfolio. Now, there are a bunch of reasons you probably already are invested in Apple, or I could tell you to invest in Apple, such as strong growth potential, global brand recognition, and the fact that it's profitable and cash rich. But one thing I want to talk about in this video that probably isn't talked about as much as it should be is expanding services segment. Apple is known for its hardware sales, but this has been something that's actually been slowing down recently. However, Apple's services segment has been experiencing significant growth. The App Store, Apple Music, iCloud, Apple Pay, and other digital services provide a recurring revenue stream and strengthen the company's ecosystem. As the services segment expands, it can contribute to overall revenue and profit growth. However, global brand recognition is still super important. Apple's brand is recognized and admired worldwide, creating a strong consumer loyalty base. This brand loyalty translates into repeat business and a steady demand for Apple products even during economic downturns, which is something that is proved over and over again with new iPhones. Apple also has ample cash reserves, which it's showcased as it has spent a ton of money recently investing in AI, which is also something that is super interesting and worth looking at. The dividend is super small on Apple at around 0.5%, but it continues to grow, and there is a reason it is Warren Buffett's largest holding. My second biggest holding is the Broadcom company, ticker AVGO. I have 5 shares of this company, which are currently trading at around $183 each, and I bought at $620, which means it's my best investment so far, up around 44%, and it makes up around 16% of my total portfolio. Broadcom is a major player in the semiconductor industry, known for providing a wide range of high-performance chips and solutions for various applications, including networking, wireless communications, data centers, and more. For example, Apple is one of Broadcom's biggest customers. One thing Broadcom is really good at is expansion through acquisitions. Broadcom has a history of strategic acquisitions to enhance its product portfolio and market reach. These acquisitions lead to synergies, increased market share, and new revenue streams contributing to future growth prospects. Despite being a growth-oriented company, Broadcom also offers a dividend to its shareholders. The company has demonstrated a commitment to returning value to its investors through regular dividend payments and has also increased its dividend over time by quite a lot. Also, just a good note, having exposure to at least one semiconductor company is definitely the play. These stocks are poised to do extremely well as the world becomes more and more tech heavy, and I'm already up just under 50% on this one stock, and I've only owned it for a few months now. Finally, my biggest position is the Coca-Cola company, ticker KO, which I have around 80 shares of, and it makes up 17.6% of my portfolio. Let's get to the point. Coca-Cola has an iconic global brand. The Coca-Cola company is one of the most recognizable and valuable brands worldwide. It has a super strong market presence and a loyal customer base, allowing it to capitalize on brand loyalty and drive sales growth. Coca-Cola's wide range of non-alcoholic beverages have a consistent and resilient demand across various geographies and demographic segments. Although you mainly know Coca-Cola for stuff such as Coca-Cola and Sprite, the company has a very diversified product portfolio and it contributes to stable revenue streams. Despite being a mature company, Coca-Cola continues to innovate and introduce new products to cater to changing consumer preferences and health trends. The company's ability to adapt and offer healthier alternatives can lead to new growth opportunities. Lastly, dividend history. Coca-Cola has a very long history of paying dividends to shareholders, making an attractive choice for income-oriented investors. Thank you for watching this video. I'm going to put my entire portfolio on screen now for you to look at. And make sure to subscribe and like this video because I will be posting more videos like this very soon. Goodbye.